Hey everyone, welcome to the last little portion of donations tax. Shouldn't take us long. You'll see, I'll show you, this is my little office behind us. My wife loves reading, I don't really. So the library that you see in the background and all the books are all hers. I maybe own about 3 of them, and excluding my tax textbooks. So that's what I read for fun. No, I'm joking, it's not fun. Nobody reads those for fun. Now, class example 3 is a good example of a sort of basic question that you would get in your type of tests or exams with respect to donations tax. So what the question says is, Mrs. Roberts made the following donations during the 2020 tax year. Cash donation of $50,000 to her daughter for living expenses while she's at varsity, a car with a cost of $120,000 and a fair market of $80,000 to her son, a grand piano with a cost of $70,000 and a market value of $100,000 to her nephew, but after 4 months he gave it back to her. A flat with a fair market value of $1.5 million to her husband. Cash to a charity of $30,000, which is a PBO, and jewelry of $150,000 to her sister. Now you're required to calculate Mrs. Roberts' donations tax for the year. I don't give you the order, I don't give you the dates of the donations, just assume they go in order, and obviously assume they're all in the same year. Now, here's what we would need to do. We have to basically take all the donations, see if they're exempt, and whatever's left behind, multiply by 20%. First thing is the $50,000 to her daughter for living expenses while she is at varsity. Seems reasonable. Okay, it doesn't say it's per month, but even if it is, what is reasonable depends on the person. In this case, there's nothing telling you that it's not bona fide. So in this case, I think it's quite clear. This is maintenance for the taxpayer's daughter. So it's going to be maintenance. It's going to be exempt. Okay. After that, what we had was the donation of a car to the son. Okay. I gave you, if I remember right, let me just go back and check. I did. Car with a cost of $120, market value of $80. Stuff you have to remember here, any donation is deemed to take place at market value. So you have a donation of $80,000, but it's exempt, not because of anything specific, but because we have the general. The general is $100,000. You can apply $80,000 of it to the $80,000 donation, and you still have $20,000 left. Okay. There was no indication anywhere that this car was, for the purposes of maintenance. You're not told anything else, so you don't start speaking about that. So remember, you're going to use market value, but when the mom donates this asset to the son, we're looking at donations tax here, but there's still going to be your recoupments, your CGT, whatever else is going on for the mother in her normal tax calculation. At the same time, you have to stop and think, is there going to be donations tax to add to the base cost? In this case, it's exempt, so no, but there could be. And you also then, in those cases, have to think about what the cost is for the purposes of recoupments and things like that. Once we're done with the car, we next have the grand piano. You're given the cost, you're given the market value, but you're also told after 4 months he gave it back. So if it's given back within 6 months, okay, it's going to be exempt. So it's not going to be subject to donations tax. If you want to talk about the higher grade side of things here, maybe start to think about the fact that, hey, it was given within, by the end of the following month, you'd have to pay the donations tax. This was only cancelled 4 months later. So actually this donations tax would have been paid and then would have to be claimed back from SARS to be exempt. Okay, that's the higher grade side of things. Then we've got a flat with a fair market value to her husband. You know that anything to a husband, to a spouse not separated, is going to be exempt. Then I tell you cash of $30,000 to a charity, which is a PBO. You know that any donations made to a PBO are going to be exempt. And then lastly, I tell you she gave jewelry to her sister. No special exemptions here. What is key? You've still got $20,000 of your general left over, so that counts. And then what you do is you add up all of your donations. So what do we actually have? Well, all we really have is this 150 less the 20, so an amount of 130. We multiply that by 20%, and that gives us donations tax of 26,000. This is a bit of a simplification because I had you look at it over the whole year. In reality, what you would have to do is each and every month, look at the donations that you made in the month before, and the same month if you want to pay them early. Add them all up, do this calculation. Remember the 100,000 only to the first donations of the year up to 100,000, and then technically each month you'd have to be multiplying by 20% and paying over to SARS. Sometimes we just ask for the simplification and say, well, how much donations tax would there have been in the year? And then we get you to do them like this. Okay. So that completes donations tax. Now, the key things to remember here is that you need to obviously know how to calculate donations tax. You need to know the process behind it. But you also need to think about how donations tax is going to interact with estate duty. If you donate something before you die, donations tax. If you still own it when you die, estate duty. What people used to do, donate the asset before they die to avoid estate duty, but then SARS had donations tax. So you're going to find donations tax and estate duty work very closely together. They have some similarities, but you're always going to have to remember what is different from each of them. Okay, the next place we're going to go is estate duty. So we'll see how it all works together when we get there. Great, thanks for listening. All the best, and I'll see you in another video soon.